Hey guys, happy Monday, and on the heels of last week's two-part video blog where I sat down and interviewed economist Ben Rabidoux, I figured let's keep that theme going. Today I'm going to sit down with my mortgage broker, Tony Della Sciucca. We're going to talk about the mortgage market as it is now and what we see moving ahead to next year. Come on. Hello everybody, and welcome back to the Last Honest Realtor. I am your host, David Fleming. Thank you so much for joining me here today. And if you watched last week's episode or listened to it on Spotify, I interviewed economist Ben Rabidoux, who is the president of North Cove Advisors, as well as Edge Analytics. And we had a great back and forth conversation about economics, about interest rates and inflation. Of course, what could be more popular in Toronto right now? Maybe the Maple Leafs, but honestly, maybe, just maybe, inflation. Today, I have brought in someone else to chat with, and we're going to have a similar conversation, but more so specifically about mortgages and mortgage rates. Of course, my mortgage broker, Tony Della Sciucca, who is sitting to my right. Tony, thanks for being here.
Dave, thanks for having me.
And
that you're dressed up today, and you're still promoting the Gatorade. No t-shirt?
No. Well, it's funny you mentioned that. So we took our team photo today down in the distillery.
Okay.
And yes, I do wear. Is that my thing? The t-shirt?
T-shirt.
Yeah. In the videos, I guess. Honestly, that is my thing in the office. I'm not going to lie. I wore a suit every day for about 12 years. And bit of a tangent here. I believe there's a relationship between comfort and productivity, and real estate is. Imagine this, what I'm about to say, it is a very difficult environment. And I would find throughout the day as I get more stressed, it was like first the jacket came off and then the shirt got untucked and then the belt would come off and then the shoes. And it's like by the end of the day, I'm half naked in the office, which is a whole other problem. And then eventually, I just said, I'm going to dress like Steve Jobs. But that's what I put out.
The red looks good on you.
Yeah, thanks. I appreciate that. And actually off camera, Jonathan wore the exact same thing. And we were in the office twinning. Everyone was laughing. And we acted like, what? What is it? Well, thanks for that. At least I know Tony's watching the podcast, the t-shirt thing and the Gatorade. Yeah, what can I say? But let's get right into it. I mean, the first question I had put here, or the first note, I guess, is, sort of why are we here? We're here to film a podcast, but people are interest rate obsessed. We're on the verge of cuts. People are looking ahead to 2025. Where are we? Give me a elevator pitch of 30 seconds of exactly where we are in the mortgage market right now.
Yeah, so I think the last 6 to 8 months, interest rates have come down quite a bit. Mm-hmm. We've seen a little bit of movement and traction with respect to people buying, mm-hmm. and the momentum seems to be shifting a little bit in the favor of some buyers. Interest rates are a byproduct of that. So when we see interest rates come down, there's a little bit more traction going into the market. So there is a little bit of activity happening now that we didn't see primarily in the beginning of the year.
Yeah, and I think we all expected this. I think me personally, and I was talking to Ben about this last time, I was a bit more optimistic for more cuts, heavier cuts. I referenced the interest rate prediction game that we had on my blog where, 2 people out of the 21 said there would be no cuts this year, which was, very, very different, but also kind of crazy. So I guess before we get into what people want to hear, what's happening with the rates, people want to understand what is going to happen, what kind of rate am I going to be looking at? Can we look backwards and just give us kind of a summary, I guess, for those that are a bit newer to this, let's say, and not everyone lives and breathes real estate. We look back to 2018, 2019. What was the environment we were in? Then came the pandemic. Then we slashed rates. What happened then? Why did it happen? Can you give us some thoughts on that? And then I guess the same question that I asked Ben last week was, did the government foresee the fallout of high inflation and massively increasing rates thereafter?
Yeah, so I think pre-COVID we had sort of a stabilized interest rate economy and environment where they were sort of in the mid threes. We didn't have.
You're talking for like the typical 5-year fix?
Yeah, 5-year fix, and variable rates were slightly a little bit lower than that. And then you had obviously the pandemic, which shifted a lot of things with respect to where the economy was, interest rates, and we saw that we had astronomically very low rates for a very long period of time.
And how low? People love hearing this. What was the lowest 5-year fixed rate that you saw?
Yeah, I mean, fixed rates were as low as 139, 129, 149. Variable rates were about 90.99 at one point in time. So you had this buffet of very low credit happening in the interest rate environment in the real estate market, and people just consumed those interest rates by purchasing a lot of inflated priced assets, and real estate was one of them. So we're now 5 years into this, and we're seeing that consumer who had a rate of 139, 149 is now renewing at something in the mid fours.
Which shouldn't kill them. I mean,
Not kill them, but they're in,
Yeah.
for a bit of a payment shock. So, you know,
Yeah.
when your payment goes up 40%, it's a big hit to take, primarily when your income levels are not increasing at the same rate. So what we're having is individuals that are beginning to re-amortize some of their mortgages to alleviate some of that increased payment.
yeah.
And, you know, just provide a bit of a buffer until these interest rates begin to subside a little bit.
And so then what, I guess, you know, I've been doing this for 20 years. You've been doing this for 20 years. If you had to say, what is an average 5-year fixed over 20 years, as low as 1.39, as high as probably, I don't know, 6.99 would probably, what's the average? What I'm trying to get at today is just sort of, what should be the expectation? Because I feel like the water cooler talk during the pandemic was people that were like, oh, I got a 1.59 5-year fix. And someone else is like, 1.59, that's crazy. I'm 1.39. Like, we're so desensitized. What would you say is the average 5-year fix over 20 years?
So the average rate, I would say, is somewhere between 4.5% to 5.5%.
Wow.
So, you know, you can see during COVID, those rates at, you know, sub 2% were almost a gift to individuals. And, you know, I joke with people, I say the party's over. So get ready for a little bit of a payment shock if you're renewing in the next year or 2 years.
But it's also like, you know, people talk about like high interest rates. And so again, I go back to my first mortgage rate was 4.99% for a 5-year fix. And that was in 2005. And my dad said, take the 6.79 10-year, rates will never be this low. I've told this story so many times. I'm sure there are people watching or listening that are like, yes, even I've heard it. But you know, what is a normal interest rate environment? And so I look at from a mortgage rate perspective, a 5-year fixed, you would expect over the 20 years that that's probably going to be 4%. And so what I'm getting at, I suppose, is that next year, and maybe this is a good segue into where rates are going, next year I believe that the 5-year fixed will be back down to somewhere between 349, 379. So two-part question. Do you agree that's where rates will probably be? And then I guess you already answered it. Isn't that below sort of the average of the 20-year, 5-year fixed?
Yeah, I don't think you're too far off. I think in the next 18 months, we should see rates sub 4%. We started seeing them not too long ago on insured mortgages and also on some uninsured mortgages. So at one point in time, we were doing 3.99.
Yeah.
The bond yields over the last little bit have crept up a little bit. So those rates are now north of 4%. I don't think it's unreasonable to think in the next 18 months, you will see fixed rates sub 4%. And similarly, I think you're going to see variable rates probably around the 3.5% to 4% range.
There you go.
So, you know, if you can just buy a little bit of time, we're not too far off from that.
Yeah, and what I've been telling people, and again, I don't want to keep repeating that I'm repetitive, but no, the point is made is that I was telling people in July and August, buy now, take a variable. And yes, you're going to eat it for 6 months, 9 months. There's nothing wrong with being early when you have a market that, again, say you're buying a $2 million house and that market is going to go up 10% between, and some people will laugh, oh, 10%, David. No, seriously. If we see interest rates plummet next year, you're buying that $2 million house in August or September, and then by the time rates are already down in May, it's a $2.2 million house. So you've saved $200,000, and what are you paying? An extra $1,000 a month over the course of 6-9 months?
Yeah. So, you know, one way to think about it right now is, you know, the gap between fixed and variable rates is almost 80 basis points. So let's use an even number just to be simple. Let's say it's 1%. On $1 million mortgage, that's obviously $10K a year.
Yeah.
So, you know, there's a big gap that you're making up in terms of interest costs to afford that additional payment until those rates come down. One of the benefits that you have with a variable rate is you can actually convert that over into a fixed rate without being penalized to do so. So to your point, what some consumers are doing now is they're inheriting a variable rate product, knowing that they can eventually convert that into a fixed rate. But to your point is you have to, you know, be able to obtain and support the additional payment for the next, you know, 12 to 18 months.
So one is you got to qualify, which again, you would think people could do. 2 is you have to come up with a payment. But again, I go back to, I don't care if you're buying a $500,000 condo or $2 million house, there is way more to lose in terms of market appreciation than there is in terms of interest additionally from taking that variable.
Yeah. And I think, you know, this as well is, you know, over the course of time, the values of homes have, you know, sort of come down a little bit. So, you know, I always tell clients, you're better off taking a house that was, call it $2 million, and now you can get it for 1.6 at a slightly higher elevated rate than you are taking a very low rate at an inflated price of a home purchase. So to your point is, I think, you know, we're not too far off variable rates being, you know, 3.5% to 4%. You're going to most likely see a 50 basis point cut in December, most likely another quarter point cut in January. And I think the target rate is going to be somewhere around 3.5 percent in the next 18 months.
Okay,
And
so-
if you have a discount on your variable rate, you're going to be somewhere around the mid threes.
Good note for later. So before we move on to predictions, I wanted to ask, when someone like Benjamin Tal talks about interest rate neutral levels, what's the goal here? And if central banks all want inflation around 2%, and that's what we typically see, right? Is every central bank says 2%, 2%. Is there a similar target then for interest rates? And then Benjamin Tal, to me, has been the most vocal person in terms of we need to cut more, cut faster. It's, they're taking too long. Give me some feedback on that.
Yeah, so I think what Benjamin Tal is referring to when he sort of talks about a neutral rate is this sort of theoretical or observational rate that allows the economy to neither expand or contract while keeping inflation sort of around the 2% range. So, right now, policy benchmark rate is 3.75%. What he's sort of discussing here is if the economy can perform at a neutral rate of about 2.5%, that there is room for rate cuts to get to that target rate faster than what the Bank of Canada is cutting currently.
Right.
So that neutral rate is really just a way that the Bank of Canada can look at it and say, is the economy neither expanding or contracting? And if they're not, we should start decreasing the policy rate to get to that point faster.
Yeah, and I'm a bit of a nerd. I don't know who didn't know that, but I love stats. I've been tracking inflation as well as interest rates. I added in a third thing on a graph, which looks cool, which of course is unemployment. So what I see is a high of 8.1% for inflation, which I believe was May of, 2022 or 2023. I wish I had it in front of me. But point is, that was our high for inflation, and nothing had been that high. We're talking monthly. I believe since I wrote this on my blog in 1982, which was when my brother was born. So of course I made that point and now I remember it. But we saw an 8.1% high. We want it to be around 2%. It slowly came down throughout this year. Benjamin Tal was saying, we need to cut sooner. We need to cut more. We need to be more aggressive. And to me, the number that was crazy was 1.6%, which was the inflation for the month of September. Now it went back up to 2.0% in October. But again, economists were saying when we hit 1.6%, economists were saying temper your expectations because in the fourth quarter, we should see it back up to 2.5, 2.6. It only went back up to 2.0.
Yeah, and so keep in mind when we look at inflation is there's a lag between the data that the Bank of Canada receives, and that ultimately they'll pick and choose whether or not they want to increase or decrease the policy rate. Benjamin Tal is obviously advocating that there is enough room in that data that we should be decreasing the policy rate, and we should be doing that a lot sooner than indicated by the Bank of Canada.
And this is good news, I guess, for any buyer out there or for anybody that's borrowing money for a car payment or what have you. But what I found interesting was, predictions can always be revised, or projections, or, if you look at, say, earnings estimates in the stock market. But we came into this year and I remember looking at the major banks and their predictions for the year. And it was somewhere between, let's say, 50 to 100 basis points by the end of the year. Okay, we've already well surpassed that. So by June, we looked at the predictions again, and the predictions were 75 to 125 basis points. It's fascinating to me to see how you can make a prediction and then sort of revise your prediction. But Benjamin Tal, and I keep going back to this point because, as I said, he's been the most vocal. He has been basically saying, this is great, but it's too late and it's not enough. And there's some articles in the Globe and Mail that I'd referenced on my blog that were basically saying we need to cut more and faster. So move on to the next point, which you had already alluded to, 50 basis points. Everyone made such a huge deal out of this. That was the last cut. Why did we see such a big cut? And then what does that mean for the December 11th cut? Projecting the December 11th announcement, which is probably going to be the December 11th cut as well.
So I think what we want to do is stimulate economic growth. Aside from real estate, we have businesses, things like unemployment, inflation, labor markets that are all sort of need a little bit of momentum, and the Canadian economy isn't doing very well at this time. So you're probably going to see more cuts than just the 50 basis points.
So are you predicting 50 basis points for December?
I think 50 in December and a quarter in January.
Darn, I had predicted 50 and 50. Anyway, so do the math. We're at 3.75. We're going to go down to 3.25 in December. We're going to go down a little bit further to 3.25. What do you see? And again, it's tough to predict and we're not going to hold you to it, but what do you see after that? I believe there's no announcement in February. March 11th, 12th, something like that is the next announcement. So where do you see this playing out through the spring in terms of what this key lending rate is going to look like?
Look, if I had to guess, I would probably expect another 100 to 150 basis point cut for 2025 and 2026 on the variable side. And, fixed sides are a little bit hard to determine because they're obviously hedged against bond yields. So, they trade on a daily basis. But in terms of variable rate borrowers, those that are entertaining or want to entertain a variable rate, I would suspect that, you're probably going to be in and around, 3.5 range by
3.5.
2025, 2026.
It's 2026. I can't even think about. That's crazy. We're finishing 2024, one thing at a time. Okay, so I guess let me take a little bit of a step back here, because again, people like hearing horror stories as long as they're not the victim of it. What was the highest variable rate that you saw a client take over the last 2 years, and when?
Yeah, so I think we saw variable rates as high as like the mid sixes, and fixed rates similarly were low sixes. So I think that this is one of the first times where we've had variable rates that are substantially more expensive than fixed rates. We're currently seeing it right now.
Yeah.
And so I think what we didn't anticipate was the velocity of how quickly these variable rates increased during COVID.
Yeah.
And we're trying to do a little catch up now. The analogy that I like to give my clients is this, is if you're looking to take a variable rate, the equivalent is like watching a hockey game and you're behind 2-0 in the first period and you got to win the game. Variable rate borrowers right now are losing in the first period. It's 2-0 and they're down.
Yeah, fair point.
And the idea here is, can you win the game? That's the risk that you're taking when you're assuming a variable rate product in today's environment.
But having said that, I don't know why anyone wouldn't take the variable right now. Excuse me, I guess I do know why, but let me ask you the question. You're working with people out there every single day. So somebody buys a house today, they're coming to you. What are they saying? And then what are you advising?
Yeah, so a lot of people, I think COVID scared a lot of people in this, high interest rate environment. People did not anticipate that their variable rates would go up that quickly.
Yeah.
So in today's environment, you're seeing people that don't want to assume that risk anymore. So if you tell someone, look, I can get you a fixed rate 3.99 for the next 5 years, they're happier than a pig in mud. They just want to keep that rate. They don't want to deal with the fluctuations of payments, and they don't want to deal with looking at the market and saying, is my rate going to go up or go down 8 times a year?
So it's the certainty. I mean, I guess if somebody had a 1.69 during COVID, now they're renewing, and you're saying you can go from 1.69 to, 5.3 on a variable, that they're going to lose their minds. Or I can get you a 3.99 5-year fixed rate now. They're opting for that.
Yeah, a lot of people are risk averse. Some people are actually splitting it down the middle. So some people say, look, I'll take a 50% fixed rate and I'll take a 50% variable rate and hedge both sides.
Yeah.
But a lot of people in today's environment, they're risk averse. And what we're trying to do, most people are trying to, they're trying to buy a little bit of time, right, Dave? So what they're trying to say is, look, give me a shorter term rate at the lowest rate possible. And in 3 years, we'll decide whether or not I want to renew this at potentially lower rates.
Okay.
So we're in an environment now where the rates are somewhat still elevated, and most people are just trying to buy themselves a little bit of time until these fixed rates and variable rates come down.
I guess there's the payment shock. So where I'm coming from, I guess, and clearly I've got a bias here, is that I think with rates coming down, and we're in this environment where we know 50 points are coming in December, we know 25 points to 50 points are coming in January. We're in this environment where the writing's on the wall, rates are going to be lower. You're basically saying if someone was in a mortgage, the shock of something over 5% is they're losing their minds. They'll take the 3.99. Let's say somebody who has never owned, they're showing up at the doorstep today. 2 questions, I guess. One, is it a different attitude and outlook than somebody that has 1.79 in their mind because they've been paying that for 5 years? And then 2, what are those people thinking?
I think most people, especially if you're a first time buyer, they want peace of mind.
Interesting.
And what they want is they want to know what their payment is going to be for the next 5 years.
Okay.
And, if people are risk averse, the last thing I want someone to do is wake up in the morning and think to themselves, is my rate going to change this month or the following month? You always want to put someone in a mortgage product where they feel comfortable making those payments. And the variable rates just don't provide peace of mind every month. Now, those rates are going to come down, but telling a consumer that your payment is going to potentially go up or can potentially come down, the uncertainty for some people is just not worth it.
So I'm just writing some numbers here. Okay, I'm Jimmy. I don't know, that's the first name I thought of for a 25-year-old. Hey, Jimmy. Okay, so Jimmy's buying his first condo. So Jimmy, you can get a 3.99 5-year fixed right now. Or Jimmy, you could take a 5.2 variable, but by next summer, you can lock into a 3.49 fixed. Your argument is, Who cares? It's
Well,
50 basis points.
my argument is you don't know. Like, I mean, you're basing some information
do.
on incomplete information. But my point is this, is that you have to convince the person who's taking a variable rate that they're going to get into something lower.
Poor Jimmy.
Poor Jimmy. With incomplete data. So some people are just risk averse where they don't want to take the payment shock of being in a variable rate. And look, the gap is 80 basis points.
Yeah.
So, the payment is going to shift for some people. If you have a $750 mortgage or $1 million mortgage, the difference of, $700-800 a month.
Yeah. Okay.
And if you're on a fixed income, it's not easy to come up with that additional money.
So let's switch gears here to investment properties. My cynical side says, what's that? Do those still exist? So I have done, it's funny that we're still new to the podcast, right? Jonathan was telling me the other day, he said, oh, you've done your 26th podcast. Congratulations. And I think the stat was less than 1% or 1/10 saying 1/10 of people actually stick with it that long. I think we're relatively new to this, but what I was about to say was that anytime we have something that people want to disagree with, right? The condo market is booming. Why you should buy now? People love to watch because they love to hate. So I have said on this podcast and in videos and on my site, I bought 2 condos this year because why wouldn't I? The market is depressed. Interest rates are high. So my cynical side is saying, yeah, what's a condo investor? Does that thing still exist? But let's say right now you're the condo investor. How does it differ, let's say between Scotia and TD, because you and I went through this, in terms of the interest rate, the products that they're offering, and then again, put your investor cap on. What is the investor thinking in terms of, could I take a variable now? Should I take a variable? Should I go with a fixed? Forget about Jimmy, the first-time buyer. Let's talk about investors, because I'm not going to make this into a plug. I do think investors are going to come back in 2025 and 2026 in a huge way.
Yeah, I think you're right. Like, the amount of investors purchasing condos is clearly non-existent these days, and a lot of it,
yes.
And a lot of it has, well, a bit of both, but a lot of it has got to do with these negative cap rates and negative cash flows every month. Yeah. So if you're an investor and you're buying a property and you're negative every month, you don't want to make up the difference of $400 or $500.
Yeah.
So relatively speaking, all the institutions are pretty much on par with the products and services that they offer. What we're seeing is that investors have kind of fled the market. And until these interest rates come down, I don't think you're going to see them come back. Now we have a bunch of pent up demand, and at some point in time, this is going to break. So I think if someone is looking to be an investor and rates get to around 3.5-4%, that pent up demand is obviously going to break, and you're going to have a lot of people start entering the market again.
And that's why I did. And when I started doing, I think I did a first couple of videos, maybe in the summer, I had a flood of inquiries from people saying, I watched the video or I read the blog, because I actually wrote some of my favorite blogs for this year. And when I do the year-end stuff, I think this will be one of them. I wrote this massive 2-part blog about the condo that I bought. But then I also wrote this blog about how to analyze the investment. And I basically took, I think it was like every condo in the downtown core that was, in C8 on the east side that was at $499. And then I compared and contrasted them by different categories, such as what are the maintenance fees per square foot, grade the location, grade the unit, the rentability. And so I ended up with this flood of people that said, hey, you got this sick deal. I'm interested. And a couple of them have bought, a couple of them haven't. People are looking at, am I going to hold this personally? I'm going to put it into a holdco. But when you get right down into it, and what you and I went through was we learned a couple of things. TD wants a 25% down payment instead of a 20% down payment. But did I have that backwards? Yes, TD wants a 25% down payment, but Scotia charges you an extra 25 basis points. That's correct, right?
Yeah.
Okay.
Most of them have premiums on rental rates, but the down payment sensitivity is different between institutions.
Yeah.
So, TD is on exception, they'll do 80% loan to value, but most likely you need to put 25% down.
Yeah.
Scotia similarly they'll allow investors to purchase with putting 20% down.
Yeah.
In terms of the rates are pretty much almost the same, but
and so I learned that. I wouldn't say the hard way, but if you have a sensitivity, say you're buying for $500,000, okay, so 20%, it's $100,000. Now all of a sudden TD is asking you for 25%. Now what I found was the first property I bought, I got 20% down with Scotia. That's all well and good. There's a 25 basis point premium. So I got my down payment, but I'm paying a higher rate. Next time around, I say, okay, I want the better rate. well, I'm going to have to put more money down. So for me, it wasn't so much the money down that was the issue, because you're investing that in something else. It was more about, I want to keep the payment low. And to be honest, I didn't want to reward one bank versus the other. I wanted to split it.
But also the cash flow, right? Like, I mean, if there's a deficit every month and it's, if you put 25% down, the deficit is $300 a month. And if you put 20% down, it's $600 a month. That's going to play a factor into, determining whether or not you want to put more money down.
Yeah.
And so, the other thing that we're noticing psychologically is as an investor, do you really want to be a landlord right now? Mm-hmm. So there's, it's very pro-tenant if you're purchasing a property these days. And a lot of people know the system. Yep. And the landlord's argument is, I don't want to put this money knowing that I could potentially have a tenant that's not going to leave my property. I'd rather put it in a GIC paying me 3%, 4%, 5%, and not worry about this until, these rates come down a bit. So there's really a two-part to this, investor pool. And as you know, foreign investors now, aren't purchasing properties anymore here in Canada.
That's another question.
So that's
He's smiling because he knows what I want to talk about after.
So, I think the appetite to be a landlord right now is very, very low. But I think in the next, a year and a half, 2 years, I think you're going to see investors come back into the market.
Yeah. And call me naive. I've been doing this for 20 years. The market always comes back. So if you take a property, like I already divulged this on the blog and in a couple of videos, one of the properties that I purchased, these guys bought it for $575 in 2020. The problem with them is that they decided to lease this out during COVID and they couldn't get a tenant and it sat empty. Then they put somebody in at a ridiculous, instead of $2,200, it was like $1,400. They need to stop the bleeding. Well, that tenant stayed for 4 years.
And as you know, you can't kick out these tenants even if you're selling the property.
No,
so
you can't jack the rent up.
You can't jack the rent up. You can't,
So
kick
these
them
guys
out.
needed to sell, and I picked this thing up for $460, right? So I look at that and I say, okay, it was a $575 condo. And again, this is the greater fool theory. People are going to say, oh, just because it's sold for something doesn't mean, if it's a share of stock of some gold mine or a biotech company, it could go to zero. Someone bought that for $575. The market will come back to it. I picked it up for $460. For me, the analysis is always like, or the analogy, is you're walking down the street. You see a penny. You're not going to pick that up. Do you see a nickel? You're going to pick that up. You see a dime, you're going to pick that up. At what point? Maybe you don't pick up the loonie. Maybe you don't pick up the toonie. What if it's a $5 bill, right? What if it's a $100 bill? At what point do you pick it up? So for me, saying, look, I can't believe that this thing was $575. It sat on the market at $599, $549, $499. I went in at $499. I offered them $460. And as we've established in the podcast before, they fought me on it, and they finally dumped it. And not everyone's going to get a landlord that wants to dump it. But to me, it was the market's going to come back. And ironically, I have calculated that this will be cash flow positive after the next rate cut. So it's not even a cash flow thing. And yes, I was down $600 a month with the first investment property, $600 a month of a loss. And you say, what kind of investment is it if you're losing $600 a month? Now, times 12, $7,200. What if the unit goes up 30 grand in value, right? It's not just about the cash flow, but what you're saying is some investors, it's all about the cash flow. Some investors, it's about the appreciation. Then you look at down payment requirements, you look at rate sensitivity. And so I guess the moral of the story is there's something for everybody out there, but my next question, are there any restrictions right now or any difficulties with any of the lenders when it comes to those investment properties other than just down payment requirements?
No, not so much. I mean, as long as you qualify, you can purchase these investment properties. The only restrictions that we do have are, foreign investors that are looking to buy here in Canada. So as you know, we have, dealing with a mutual client that is, they're non-residents.
Yeah.
So they're not Canadian citizens and they're not permanent residents and they want to buy a property here. Unfortunately, because of the foreign buyer ban, they're not able to purchase until they have their citizenship and permanent residency. There are some exceptions if you're buying under populated areas under 100,000.
Yeah.
But there are tax implications for these foreign investors. In other words, on top of the line transfer tax, you have a 25% provincial tax as well too that you have to pay on top of purchasing the property.
So let me move on to that point because. Okay, so Tony and I have a mutual client, and I will try to protect their anonymity here, but let's just say that it's a couple. They came from the United States, highly recruited, highly sought after. Now that's what we want in this country, right? They work in education. These are not contract people. This is not part-time. These are tenured professors, and they can't buy a house.
Yeah, sadly, they've got to go through the process now. We have this new Prohibition Act where if you are a non-resident of the country or you're coming here to work or on a visa, you need to go through the process of obtaining your citizenship and permanent residency before you can purchase a home. Now, you can purchase it if you want to pay these elevated taxes, but I don't think anybody is wanting to dish out additional money.
So they're going to buy for $2 million, right? And the tax is 25%, so 400,000. So again, part of society, and I always love going here, part of society, they can afford it. They have $2 million. First of all, never mind, I'm not going to finish that sentence, but you know where I'm going with this. So my thinking is, and I'll say the unpopular thing, which actually didn't become so unpopular last year, as I wrote on my blog, when people started to talk about this thing called immigration or, the foreign buyers, is that these rules came into effect because there was this idea or this fact, depending on which side you're on, that so much of Canadian real estate was being used as a safety deposit box for foreign buyers. I'll take it a step further. People say foreign buyers. Let's name names. There's a belief out there that people from Hong Kong are showing up here and they're buying our real estate in droves. May or may not be true. But whether a person's from Hong Kong or from Bolivia, I think the idea behind these regulations were to make sure that people in Canada could own for the right reasons. Now, the wrong reason is the person from one of these rich countries who has monopoly money, or rather Canadian money is monopoly money to them, who is using our country as a safe haven, as a safety deposit box, buying in pre-construction, assigning it, not declaring taxes, not paying for the money they're making. But for Bob and Susie to move here full-time, put their kids in school, working as tenured professors, sought after, recruited, I think it's insane that they can't buy
it. And look, let me backtrack a little bit here. There is an option to potentially get your tax back, but good luck trying to get money from Revenue Canada to go through that process.
Yeah.
So I think the safest decision for them is to just wait till they have their permanent residency status and purchase a home like a Canadian citizen. So
Revenue Canada, great story about them. They asked my accountant for 3 receipts for things in 2023. I didn't have the 3 receipts. Unfortunately, I now owe them $60. And all I could think about is how many hours went into this? How many people at Revenue Canada and how many hours? And again, say it's one person and it took an hour. It's absolutely insane. So that's an aside. Yes, we could talk about this.
Squeeze $60 from 2 million people. You're making a little bit of money,
right? But you're hiring more auditors,
sure.
And what's the stat? We have the most auditors per capita in the entire planet. So I guess that one bothers me a bit. And to Tony's point, what he's saying is, let's say that you did want to buy and you said, okay, here's the $400,000 and I'll get it back. The first problem is, and again, for the people...
And it's not guaranteed.
Right, it's not guaranteed.
Yeah.
As I say, for the first problem is for the naysayers who I don't actually think are watching this. People are like, they can afford it. They have $2 million. They don't, okay? That's actually a lot of money, $400,000. But I also think, in addition to you saying that they're going to have to fight to get it back, the issue becomes they might only have 25% for a down payment. Yeah. They might be putting $400,000 down, taking a 1.6 mortgage. It's not like you could just throw $400,000 at it.
Well, $400 grand of after-tax dollars is really $800,000. So
exactly,
it's a lot of money.
Yeah. So going back to CMHC. So we talked about, unfortunately, NPRs, non-permanent residences, are not able to buy right now. CMHC brought in some regulations about a month ago. First of all, they introduced the 30-year amortization across the board. And yes, we had that previously only on pre-construction because, of course, the government's trying to stimulate building, even though, and here goes David on his tangents, really, I think it's the 26 to 29% of the purchase price that's made up from taxes of the municipal, provincial, and federal governments. That aside, David, we've heard this from you. The government said, sure, you can have a 30-year AM on pre-construction. Now they've made this a rule across the board. And then in addition to, or more importantly, our insurance cap went from $1 million to $1.5 million. Which of those is going to play more of a role? Do you agree it was time to bring those both in?
Yeah, so I like both of these, and let me just recap them a little bit more, fine-tune this a little bit, is if you're a first-time buyer and you want to purchase a property, you can go up to $1.5 million and obtain a 30-year amortization. If you are not a first-time buyer, then you can, again, purchase up to $1.5 million, but the maximum amortization is 25 years. So I'll preface this by saying that the barrier to entry to owning a home in Canada is progressively getting more expensive and more difficult.
Yeah.
So what you have is you have these professionals that are coming out of school, they're dentists, doctors, lawyers, or whatever the case might be, and they have great incomes, but they're capped at, previously buying a property at $1 million and having to put the 20% down. So let's make an example out of this. You buy a property, $1 million, $200K down, land transfer tax, closing costs, call it $250,000. You need, again, $250,000 of after-tax money to purchase $1 million property in Canada. I can tell you that not a lot of people have this without the help of mom and dad.
Right.
So these policies that are coming into effect, I believe it's December 15th or 16th,
Yeah.
will allow these individuals who have great incomes to purchase these properties at a reduced down payment structure. And I think it's, in my opinion, little risk to the banks if you have qualified borrowers that are managing these payments.
Little risk to the bank because the CMHC is backstopping it.
Yeah.
That's another question. We'll come back to that. So I guess what you're saying, and I use the example, and I actually saw these clients not too long ago. It's been, I think, 6 or 7 years, ironically. I always tout the story of, this was a young lawyer couple, and they said our max is $999 because we can't afford to go over $1 million because and this is before it used to be 5% up to $999.
Yeah.
And again, a few years ago,
$499. So it was 5% of the first $500,000,
Yes.
and then anything from $500,000 to $999 was 10%.
Right, but I'm talking about before the 10% came
correct,
in, right?
yes.
So you go back far enough, right? To Tony's point, yes, this is another regulation, and CMHC, to their credit, they've strengthened the banking system, and we did a podcast on this very early on, but there's been a lot of changes to strengthen the system, and we have one of the best systems in the world. But at the same time, you don't want to penalize people or make it so difficult to purchase. And what I was saying was, once upon a time, you could buy for $999 with only 5% down. So these guys bought for $999 with 5% down, which is 50 grand. At that time, had they gone to $1 million, they would have needed 200. So they were lawyers. They had excellent incomes. They could afford the monthlies, but they didn't have the down payment. That is the point that you're making.
Yeah, and I also think, let's look back a little bit. You had a consumer who, let's say 7, 8, 9 years ago, bought a condo for $900,000. You're putting 5% down, that's $45,000.
Yeah.
In terms of what they've risked to purchase that property,
Sure.
it was very little, $45,000.
Yeah.
Fast track 6, 7 years later, that condo that they bought for $750 or $800 is now worth $1,314.
Yeah.
And what do these people typically do? Is they, treat the home like it's an ATM. They go back into the property, pull money back out, and either spend the money or purchase another property.
Yeah.
So I think what's happening here is the Bank of Canada and policymakers are trying to figure out what's a threshold where we can sort of create a down payment that is equitable and fair for everybody. And I think with this policy here, I think they've done a reasonably good job.
Yeah.
I'm interested to see the data that comes out in terms of how many people are buying between first-time buyers between $1 million to $1.5 million.
Yeah.
Probably won't get that data for at least 6 months, but I'm curious to see.
Or if ever, yeah.
Yeah, I'm curious to see what that data will look like.
Yeah, and I think if you look at, obviously, when we had this ill-fated idea product from the federal government, which of course was a shared equity mortgages, the objection to that was, hey, that sounds great, but you can't buy this in, 70% of the country, right? So if you want to buy in, the Yukon, great. I think the same is true for, if you look at the average home price in Toronto, which is $1.1 million, and you look at the average home price in Vancouver, which is slightly higher, you can't buy an average property with CMHC insurance if we did not have this increase in the mortgage cap from $1 million to $1.5 million. So this will get more people in the market, but it also means that CMHC is backstopping the banks even further. So
of course,
your thoughts on that, because a lot of people on my blog over the years have commented, and I'm going to typecast them and say that they are over 60, they bought their houses a long time ago. Easy for them to say, I don't want this in the backs of taxpayers. But the CMHC basically is a fail-safe for the banks.
Yeah, look, we have an affordability issue here is, how much can a consumer afford to buy a property? The general metric is this, is if you take the gross household income, you multiply by about 4.5, that's typically what you qualify for in the form of a mortgage.
Yeah.
Historically speaking, if we go back 20, even 30 years ago, your income relative to what you were buying a house for was maybe 3.5 times.
Yeah.
In today's environment, your income is probably around 7 to 7.5 times of what you're buying.
Yeah.
So I think we've reached a point where we have to sort of shift the narrative and say, what can we do to increase affordability for individuals who want to get into the market? Owning a home in today's environment is like having a luxury vehicle. It is progressively getting harder and harder to own a home. It will eventually, particularly in major cities, it will get to a point where it will be too hard to own a property in major cities if you already don't have a property or if you're not getting some form of inheritance.
Yeah.
And renting will become more popular.
All right, so it's so unlike me to make this political, but what I will say is if you look at an established city like New York or London, there's an understanding. People don't expect to go there and be able to own or afford or purchase a home. I feel like, and I've been saying this for a long time, Toronto was 30, 40 years ago a place where, yes, anyone could own a home. It's not anymore. I believe that the federal government, at least the current iteration, has been advancing this idea that everyone ought to or deserves to own. But I think to your point, what you're saying is, your example of it's becoming a luxury, and just using this as an example, we've seen the CMHC change down payment requirements because even the lawyer or the banker, sure, they can afford the monthlies on that $1.4 million house, but they don't have the down payment. So moving forward, I agree with you if that's what you're saying. And yes, Toronto will become a place where only a small percentage of the population can actually afford to own a home.
Yeah, and look, I also think there's this sort of psychological mentality. It's okay to be married with 2 kids, have a good job, and rent in the city of Toronto.
Absolutely.
There's absolutely nothing wrong with that.
Everyone in New York rents. Everyone in London rents.
Agreed.
Why is Toronto expected to be any different?
Yeah.
Yeah. So I guess one last question about the CMHC, Bank of Canada. I wrote on my blog, if I was king for a day, Toronto Real Estate Board, what are the changes I would make? I guess I'd ask you the same thing, being in your chosen field. If you could do something at the Bank of Canada, if you could do something at CMHC, what would you want to enact?
Yeah, I think right now the stress test seems to be one thing that I would probably remove, especially in a descending interest rate environment. So, having people qualify at, 7.5% to own a home, or 6.25%, whatever it is a little bit overkill.
Yeah.
And then also, if I'm being somewhat selfish, I wish we just had a product that you could take instead of a 5-year fix, something like, 20-year fix. You protect consumers, you protect a little bit of the market, where people don't have to worry about sort of getting into a boxing match every 5 years with your bank and having to renegotiate these rates. So if there was those were 2 changes that I had to pick from, I think remove the stress test, and cross your fingers that at some point in time you can have terms longer than 10 years.
And I think the stress test is on the radar. I've read a lot about this, and understanding why it came into effect, where freight rates are going to increase. We want to make sure people can afford their payments once rates have increased. Now we're talking about rates decreasing. Why are we still approving people 2% higher than is necessary when rates are decreasing? So your point, of course, about the 30-year, the US, they have that. And when people come here and I say, well, the longest you could take is a 10, they then fight me on it. They're like, no, because what I did with my house in Texas, and I have to explain to them that we're not in Texas or Kansas anymore. So we're just about at time here, I guess. I'd say last question. Obviously we work with you. Tony has financed every property that I've ever purchased. So in terms of the differences between working with a broker and working with a bank, I know a million differences. I know why I always work with a broker, why I refer that to my clients. But if the people that I guess are new to this, what would you say are the differences, and why do you have a loyal clientele?
Yeah, one of the benefits with working with a broker is you have access to different institutions. So, on the broker side, we have access to, your major banks, your non-major banks, private lenders, subprime lenders, and every client sort of fits within a bucket of that institutional behavior. And also, preferred rates with, these institutions, and then also a level of experience and expertise that, you may not be used to. So whether you're a first-time buyer or a seasoned homeowner, there's a mortgage out there for everybody, and our job is to help out as much as we can.
Yeah, and I can speak to all of that from experience. I can say, I remember a deal working with a young couple, and we were in multiple offers, and it was 9:30 on a Saturday night. And they said, we don't know if we can go higher. We would need to talk to Tony. And I said, give him a call. Now, I'm not saying call Tony at 9:30 at night. My point is that Jimmy at the bank, I keep using now Jimmy.
Poor Jimmy.
Right, Jimmy at the bank. Jimmy's chair is spinning at 4:56. He's not talking to you. So I get the worst possible service from the bank. And the irony is, and we've talked about this many times, you expect to get the best service from your bank. They're going to give you the worst possible service because they already have your business, and they're out there trying to chase new business. So the very people you think should be rolling out the red carpet are deliberately giving you the worst possible service. And then on top of that, we had an interesting experience with TD on the last purchase, and to actually see what happens behind the scenes, the most, I'm sorry to say, inept, unwilling to work folks, but topic for another day. Don't want to end on that negative note, but that is, of course, why we recommend Tony, why I use Tony, and why I think anybody watching should be with a mortgage broker and not the bank. So thank you so much, Tony, for joining us today. And for everybody watching or listening, please drop us a comment on YouTube. Please remember to like, comment, or subscribe wherever you get your podcasts. And we'll see you next week on The Last Honest Realtor.